Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. My name is Dana Hart, and we welcome you to our next episode in our special series addressing transfer pricing readiness amid economic uncertainty. In today's episode, we will be discussing comparability considerations and challenges. It may seem obvious that the degree of comparability of current year results to prior year benchmarks is diminished in the current environment. However, the question is not only to recognize differences, but to address how to consider these differences within the widely accepted principles of transfer pricing. Here today to discuss this, I have Kartikeya Singh. Kartikeya is a transfer pricing partner with PwC US. Marta Milewska. Marta is a transfer pricing partner with PwC Mexico. And Paul Tang. Paul is a transfer pricing partner with PwC China. Kartikeya is the moderator for this podcast today, so Kartikeya, over to you.
Thank you, Dana, and welcome everyone. So today we're going to be discussing three interrelated questions and issues, and all of these issues are fundamental to the types of challenges that taxpayers and practitioners are facing in today's environment. And these challenges particularly relate to ensuring comparability. And as everyone who's done transfer pricing knows, comparability and ensuring comparability between related party transactions and unrelated benchmarks, whether they be in the form of transactions or companies, is a cornerstone of applying the arm's length principle. And the three interrelated issues are, number one, data limitations that particularly heighten the comparability challenges in this kind of an environment that we're in right now. Number two, the importance of delineating and truly understanding the nature of the adverse and unique economic conditions that are impacting taxpayers in today's environment. And then number three, the adjustments and refinements that one can make in addressing some of these challenges that arise from, on the one hand, the unique economic conditions and circumstances that we have, and the data limitations that taxpayers typically face in overcoming and trying to address, meet those economic conditions and circumstances as a comparability criteria. And before I move on, I'm just going to level set or set the stage very quickly. The economic conditions or circumstances form the backdrop of transactions, and so clearly have a bearing on what an arm's length price for those transactions would be. And both the 482 regulations from a US perspective and the OECD guidelines from a global perspective recognize the importance of economic conditions or circumstances as a comparability criterion in its own right. And again, the economic conditions or circumstances that we're talking about and that the OECD guidelines and the Section 482 regulations talk about, and that form the backdrop of transactions, could be the larger macroeconomic conditions, could be the unique industry conditions that shape the actions and the outcomes of market participants. So with that being said, I'm going to first hand it over to Marta to talk about and discuss the data limitations that companies typically have to grapple with in this kind of an environment.
Thank you, Kartikeya. So first, I would like to point out there are two elements that relate to data limitation impacting comparability. First, a lack of comparable data from the local market. And the second one, the timing of obtaining comparable information. So let me focus on the first one. As of the lack of comparable data from the local market, we need to point out that many countries, especially developing ones, have scarce comparable data. The scarcity in local publicly available data is attributed to various factors, including, among others, a relatively small size of the economy, the fact that many companies are private, family-owned, or state-owned. Therefore, the transfer pricing practitioners often rely on information from other markets. However, specific circumstances related to the COVID-19 pandemic may have a different impact on each market. For instance, in Mexico, we often rely on the US comparables. However, The COVID-19 pandemic circumstances might challenge this typical transfer pricing practice that comparables from the geographically closest countries are superior. The transfer pricing analysis must rely on comparables from countries that have similar circumstances as the country of incorporation of the tested party. So in that respect, industry analysis now in the COVID-19 pandemic is becoming of great importance for the purpose of transfer pricing and identifying comparable circumstances. Now, as of the second element that relate to data limitation impacting comparability, timing of obtaining comparable data, I will switch to Paul. Paul, what about the timing and what's the impact on the transfer pricing analysis?
Thank you, Marta. When we do benchmarking for related party transactions for 2020, very likely the latest comparable data is from 2019 or even 2018. On the other hand, the OECD TP guidelines require that taxpayers set transfer prices based on information that was reasonably available at the time of the price setting. And more specifically, transfer prices should be adjusted to unexpected events. Following the guidelines, taxpayers, no matter as routine or full-fledged entities, should consider the COVID-19 impact on the transfer prices, even though no concurrent comparable data is available. One of the solutions for developed markets might be to observe the change of market price of comparable companies during economic downturn. For example, taxpayers may leverage the analysis done for the period of global financial crisis in 2008 to 2010 to see how the profitability of comparable companies or market prices would change when companies experience significant demand contraction. This may throw light on how the tested parties would expect profitability fluctuation during COVID-19 period due to demand contraction or supply disruption. In this regard, PwC Belgian team has performed an historical regression analysis using the data of European entities for the period from 2006 to 2018. It indicates a strong correlation between GDP growth and operation margin of routine or low-risk entities. Such conclusions apply to manufacturing, distribution, and services industries. PwC US team also conducted a panel data regression analysis on the US distribution entities, which shows statistical correlation between the change, i.e. decline of the sales revenue and operating margin of comparable companies. Similar conclusion applies to manufacturers as well. Taxpayers may use such analysis to anticipate the potential impact of COVID-19 outbreak on the profitability of the tested party for 2020. However, as Marta mentioned, comparability analysis based on historical data may pose difficulty for certain jurisdictions such as mainland China. According to the National Bureau of Statistics, China GDP growth contracted significantly by 6.8% in Q1 year on year, which is the very first time a contraction was recorded since the start of reform and opening up of the country for more than 40 years ago. This means that we cannot locate enough data from past years to observe and analyze the movement of profitability of Chinese local companies during economic recession.
Thank you, Paul, for that. And thank you, Marta, for that, for laying out the unique data limitation challenges that we face in this kind of an environment, and also alluding to some approaches that one can try to address those limitations, which may work in some circumstances. And again, that, we'll talk about that a little bit more later in the segment. I want to move now to another aspect, and Paul, you touched upon this, which is that when we're talking about, we are in an economic crisis, and it's an economic crisis that's been brought about by a pandemic, but different companies are being impacted differently. Some companies, even those that are faring badly, and it's not a given that everyone in this environment is doing badly, but those companies that are doing badly, they may be doing badly in different ways. And when I say that, I'm reminded of this saying from Leo Tolstoy that all happy families are alike, but all unhappy families are miserable in their own way. And when you look at companies that are maybe not faring well, they could be faring badly because of unique, adverse demand side conditions, or possibly through adverse supply side conditions, lack of access or inadequate access to inputs, difficult working conditions, and higher costs of doing business because of the disruption and the safety precautions that have to be undertaken. So, given that backdrop, Paul, it would be helpful if you shared some of your perspectives in terms of what you are observing and what you have seen in terms of the impact of this crisis across different kinds of companies.
Absolutely. Why COVID-19 becomes a worldwide humanitarian crisis, its impacts on different industries will be polarized. Taking China as an example, we believe the following industry sectors will quickly recover or even achieve growth in China. So number one, digital economies, in particular on online businesses such as education, games, and retail. Number two, high-end luxury retail in China. This is caused by less global travelers and more local consumption in the market. However, there will still be negative impact at the group level. Number three, network hardware and software products. And number four, consumer electronic products. On the other hand, some other industries will experience deeper contraction. For example, we have seen food processing industries registered minus 29% growth for fixed asset investment in Q1 in mainland China. Total retail sales of consumer goods contracted by 19% year on year in Q1. Catering consumption fell 44%. Retail sales of physical goods contracted by 16%, and automobile sales dropped 30%. Even with the discouraging statistics in Q1, we found that the Chinese consumers and industry players are relatively optimistic about economy recovery. According to the COVID-19 TP survey done by PwC China, about 84% of the Chinese companies considered that their business would recover within 2020, and around 52% of the Chinese companies anticipated that their sales would drop by less than 20% due to the COVID-19 impact. We noticed that in this region, Australian Tax Office, ATO, has already released guidance on transfer pricing and COVID-19. ATO made it very clear that they will assess economic circumstances where the actual economic impacts of COVID-19 on the Australian operations should be outlined and evidenced. ATO also encouraged a so-called but-for analysis for COVID-19 impact, which may include a detailed profit and loss analysis showing changes in revenue and expenses with an explanation for variances resulting from COVID-19. Obviously, different tax authorities may take different views in assessing COVID-19 impact for transfer pricing. In the recent online Q&A session, the local tax authorities in Beijing city level reinforced that according to the Chinese domestic law, enterprises engaged in simple manufacturing, simple distribution, or contract R&D services should maintain a reasonable level of profit. If those enterprises incur loss, they should prepare local files for loss-making years, no matter whether they exceed the TBD threshold. So, Marta, what you can share with us from your observation?
Thank you, Paul. So, talking about Latin America, the COVID-19 pandemic is expected to trigger a severe economic contraction. While changing oil and energy prices will affect commodity-dependent economies, while sharp drop in remittances and diminishing demand from China, the US, and other economies will inflict significant economic pain across countries. Also, the collapse in tourism will be harmful in the Latin America. In case of Mexico, as of July 2020, PwC prepared a special report for each industry to observe the gross value added for 2020. And we can see that depending on the industry and whether we will be observing a VU or L type of a curve crisis, some industries might suffer a very negative effect that goes from -10 even to -20% of gross value added. Some of those industries include automotive, retail, non-food, entertainment and media, services, passenger transportation, and as I mentioned earlier, tourism. Industries with negative effect, which is around from -5 to -10% of gross value added, include industrial manufacturing, chemicals, utilities, financial services. Some examples of industries with slightly negative effect, it's around from -1 to -5% of gross value added in 2020, include agriculture, pharma, technology, and software, healthcare as well. Telecommunication, as well as food retail industries, are expected to have expansion potential. So having said that, the evidence, it means the behavioral and or quantitative obtained from actual arm's length dealings between unrelated parties during the current economic environment can offer valuable insight. At PwC, we have developed a database that retrieves data from the market, which may be helpful to support circumstances and behavior of third parties. Now, please consider that many multinationals have subsidiaries operating in developing countries, in my case, Latin America, under a limited risk model, and the transfer pricing analysis would require not only testing the impact of the COVID-19 pandemic on the industry, but also impact, if any, of course, on the limited risk model. We have an interesting example from the Mexican market where we have the maquilas. It's a limited risk model, toll manufacturing model. The companies are compensated under a simplified mechanism. They have two options, safe harbor and fast track. However, those mechanisms are not reflecting the COVID-19 pandemic circumstances. So currently the IRS and the Mexican tax authorities are working to finalize a maquila framework, including a review of comparable set for the fast track mechanism.
Thank you, Marta. So I think, what we've covered so far is, obviously, we've talked about the unique data limitations and the challenges that come from that get exacerbated in this kind of an environment. And also, we've touched upon how, even though it is a downturn, it is a crisis, it is not uniform in its impact across different industries and different companies. So moving on, let's talk a bit about what kind of adjustments and refinements one can make in our typical transfer pricing analysis when we apply the arm's length principle to overcome some of the challenges that we've talked about, and in keeping with the true delineation of how the present environment and the economic circumstances might be impacting a specific taxpayer and a specific counterparty to a transaction that we're analyzing. I'm going to start with you, Marta, please.
Sure, thank you, Kartikeya. So when speaking about adjustments, I think we can divide them into two groups, the statistical and economic adjustments. So maybe first start with the statistical adjustments. In the context of CPM or TNMM analysis, an example of the adjustments made on the side of comparable statistic techniques, such as the regression analysis previously mentioned by Paul, may be a relevant and impactful avenue to address one set of comparability issues, challenges we may have, for example, related to the adverse demand shocks. An adjustment to the, let's call it, normal historical results of benchmark companies could be derived based on the estimated relation between, for example, observed profitability of the benchmarks and the economic shocks. Let's say suitable quantified proxies by independent variables. And the other group of the adjustment, the economic adjustment, has a little bit different context. So the challenges discussed previously may also require us to look for another alternative solution within the context, of course, of the arm's length principle. As of the economic adjustments based on the suitable economic model, let's call it again the adjustment factor applicable to the normal profitability results of the benchmarks, for example, observed during 2017 and 19 period can be derived. The different econometric model specifications can be considered depending on the nature of the specific issue and data, for example, real options models, among others. Furthermore, for the application of CPM, TNMM analysis, I would add a need to define whether adjustments are made to comparables or rather to the tested party. Depending on the nature and scope of comparability issues, for example, shaped by demand side shock or supply side shocks, adjustments may need to be made on the side of comparables or the tested party or both. And based on my experience, some countries might prefer adjustments to comparables or even reject adjustments to the tested party data. And irrespective of the comparability adjustment made on the basis of historical financial data, a corroborative analysis could ideally be conducted ex post. It means at the end of 2021, when comparable financial data for 2020 will be available, in order to confirm the relevance of the adjusted results obtained a priori and to support, of course, the reliability of the adjustments performed.
I totally agree with Marta's comments on the comparability adjustment. In addition to the technical analysis, MNEs should also define the COVID-19 impact and its period from a business operation viewpoint. Say, what does COVID-19 mean for your industry, for your group, and your entity on a standalone basis? Is it a survival issue or business disruption issue? To take an extreme example, in February, we witnessed that a lot of areas in China experienced a complete lockdown. In this case, it would be not that reasonable for a Chinese manufacturing entity to still maintain a stable profitability from related party transactions if there's simply no business activity at all. If survival or ongoing concern is the issue, independent enterprises may accept or strike a deal that allows it to earn cash flow at a minimal level to maintain its operation. If the tested party can quickly recover from lockdown and enter into a disruptive business model, say sales revenue may decrease 10 to 30%, comparability analysis based on historical data or but-for analysis would be helpful to determine whether and how to change the transfer pricing policy, i.e. the target profitability of the tested parties for 2020. MNEs may need to address the COVID-19 issues by territory and by phase. COVID-19 is a territorial risk in nature, and business operations by the affiliates and subsidiaries belonging to the same group could be quite different, considering the control by different governments vary significantly. Also, headquarters tax team may not only explore the feasibility of changing the target profitability, but also thinking about the other options realistically available, such as compensation of total cost or recovery of variable costs only if the group as a whole face survival or ongoing concern. In this regard, facts collection and documentation will be pivotal to support a potential change of transfer pricing arrangement during the COVID-19 survival period. What we have discussed is about the application of CPM, TNMM during the COVID-19 difficulty. It should be noted that business operation during the COVID-19 period may also pose challenges on the taxpayers if they use two-sided method, say profit split, because costs and expenses may change significantly during the business disruption. Examples could be additional IT investment to support staff working from home or to procure touchless equipment for a retail store. Marketing expenses may be moved and centralized to online advertisement, which might be borne by another entity. MNEs should closely monitor the application of profit split method as well and make a proper adjustment, even though benchmarking analysis might not be that important.
Thank you for that, Paul. And thank you, Marta, before that. I think this has been a great discussion. I think we've touched upon some really important themes in light of, how does one approach transfer pricing in an environment which is as typical as, from the normal, what we consider normal steady state conditions. as we're seeing right now. And as both of you have highlighted, I think it's clear that the story has to start with a thorough and proper understanding of what exactly these conditions truly mean for the business and how are they impacting the business? What are the channels through which they're impacting it? It is only then that we can then look at, adjustments and refinements. And both of you talked about, several possibilities in that regard. Adjustments and refinements that could apply on the side of the comparables, the benchmarks. B could apply on the side of, the tested body to the extent that we're using one-sided methods, as you mentioned, Paul, or maybe a combination of the two. And then the other nuance that, Marta, I think that you raised, which is going to be an important consideration, is not losing sight of what exactly might carry the day in the relevant jurisdiction where this is going to be tested, and knowing that at the end of the day, our selection of what kind of refinements we apply need to take into account the taxing authority and the taxing authorities that are going to be auditing this at the end of the day. So I think those are all excellent points. Next, I'm going to turn to each of you to highlight some key takeaways that you want to leave us with. And I'm going to start with Paul first.
Thank you, Kartikeya. I would say business always comes first. The present recession is unique, so there's no historic playbook. Taxpayers need to thoroughly understand, as you said, how business and industry evolves during the COVID-19 pandemic and how independent entities would respond to such unexpected disruption. In addition, as COVID-19 is a territorial risk with global impact, it needs both local management teams' input, i.e. implementation based on the local government's requirement, and headquarters guidance from a strategic perspective. A matrix analysis by territory and by phase may help the group navigate through the crisis from a transfer pricing perspective. Marta, what do you think?
Thank you, Paul. So very in alignment. And I would add that COVID-19 pandemic would require us to rethink the way we perform transfer pricing analysis, starting from some basic questions as whether we can continue using the same comparables, if not, what adjustments should be made to increase the comparability, or where we can obtain suitable data. Other markets, historical data, if no good data, maybe developing new financial or economic models may be a solution. So in summary, I would say exceptional circumstances require exceptional approaches and adjustments for transfer pricing.
Thank you, Marta. I'll conclude by saying that, as a transfer pricing practitioner, I think even in the best of times, we're dealing with, data limitations, imperfect comparables. But those challenges obviously are manyfold magnified in this kind of an environment. But hopefully what this discussion brings out is that those challenges can be overcome and in a manner where we can still apply the arm's length principle in a reliable manner in this environment. The key to doing so, obviously, as you both have laid out, starts with truly understanding the nature of the conditions that are impacting the business, and then selecting, within our toolkit, the different kinds of approaches based on a considered, judgment, taking into account the nature of the impact, the data available, and also keeping in mind, the taxing authorities that are going to be looking at this.
Thank you, Kartikeya, Marta, and Paul, for sharing your insights. And thank you to our listeners. We will continue to release these podcasts regularly and as the transfer pricing environment demands. We also encourage you to reach out to your regular PwC transfer pricing contact for immediate response. As always, your PwC team stand ready to accompany you on this journey every step of the way. Stay safe and healthy. Thank you.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.